travel isn't just about destinations, it's about the people you meet, the cultures you immerse yourself in, the stories you carry home. I'm Relebogile Mabocha, and on my travel feature, I take you on a journey beyond the guidebook. Each week, I connect with fellow travelers, insiders, and storytellers to bring you the heart of every place, whether it's a hidden gem right here in South Africa or a dream destination abroad. Join me as we travel through conversations, memories, and inspiration. Listen wherever you get your podcasts.
The Money Show.
Personal Finance with Warren Ingram.
23 minutes now to 8 the time. One of the most important things to do when you're trying to invest is actually an issue of consistency. And that's something that we're going to be focusing on today and just looking at how this managed. Warren Ingram, of course, is a certified financial planner at Galileo Capital. And his question, Warren, that you're asking tonight is, are you chopping and changing your investments to zero? And I have to say, this is really about that urge when you've made a decision to change it because it's not working out for you.
And it's such a human instinct, Stephen, where we see a problem and we want to take action and we want to correct the problem and drive our investments in a new direction. And it's a very human thing. We're hardwired that way. Usually when we were kind of pre-civilization times, hanging around and thinking about things and taking our time probably would mean that we would be killed by a predator. So it was, entirely in our interests and in our wiring to make sure that we did something about the problem, either ran or climbed a tree or fought. And those are all great instincts for survival, but unfortunately, terrible instincts when we're in the investment world. And it happens so often when we talk to people about money that and things are not going well. For example, there's a big stock market crash or there's political upheaval. That just sounds like every day in 2025 so far. But when that happens, people want to know what's the plan, what's the action, what should I do to fix the problem or stop my investments losing more money. And very often, the best answer you can give someone in a situation like that is sit on your hands and don't do anything. And it's almost the hardest thing to do.
The other point is that I suppose you end up changing your investment at the worst possible time because it's a moment of great stress in the market.
Yeah, so there is this phrase, the madness of crowds, and if you want to see the lack of intelligence of a crowd, the best way to do that is look at a large number of investors taking action almost at the same time, and so the biggest crowds to me that you can really measure are global stock markets, and when we analyze the behavior of investors. And the thing to understand here is I'm not having a dig at just professional investors or just private investors. I'm talking about all of us, all investors. When you see what we do and the decisions that we make as a collective, they're not that clever. With the benefit of hindsight, when we look back and we analyze what's happened, we tend to collectively make the biggest mistakes at the same time, and we do it repeatedly. So just to give you an idea, in the beginning of 2024, investors sold about 35 billion rand out of unit trusts in South Africa, and the sector that really suffered the worst outflows was those that invest, especially unit trusts in this case, that invest on the stock exchange, on the Johannesburg Stock Exchange. And the sector that benefited the most, so the unit trust sector that got most of that money, was the money market unit trusts. Now, over the whole of 2024, the JSE delivered a return of 13%, which is pretty good return. That's that if you do that for 6 years, you've doubled your money. And at the same time, money market unit trusts delivered a fantastic return of about 7 or 8%, and that's not taking into account tax. And just to be clear, I'm being sarcastic there. 7 or 8% before tax is really not a good return. So in essence, you switch out, and we do it collectively. We switch out of the thing that did badly the year before, and that's exactly what happened. The JSE didn't do well in the year before, and so we switch out collectively, all of us, and then we put all our money in cash because we want certainty, and so we end up with a return after tax of probably 4 or 5%. While the JSE delivered a return of 13%. And that's the point there, Stephen. Do nothing and you get the 13%. Do something and you get 4 or 5%. It's a really bad outcome.
Okay, so then what do we do? I mean, how do we approach this? And, you can be sitting on the edge of your chair, not even able to sit down at all, because you're just so nervous watching your money disappear, or it can certainly feel like that.
And maybe that's the very first thing. You make such a great comment there. We're investing is not an entertainment. It's not an action sport. It's not a game. We shouldn't be watching our investments very often. We shouldn't be looking at them daily or weekly or monthly. If you're doing that and you're getting a form of entertainment, and sometimes like watching your investments go down can be like a gruesome form of entertainment, like watching a car crash. That you need to understand things are not going well for you, because investing should just not be a form of entertainment. Then you're doing it wrong. It should be boring. So if you own an investment that hasn't done well, let's use the example of a unit trust that invests in the Johannesburg Stock Exchange. If it hasn't gone well, then what you need to do is go and Google and see what did the Johannesburg Stock Exchange actually deliver over the last 12 months, and then compare that to your unit trust. If your unit trust has gone down by 5% and the Johannesburg Stock Exchange has gone down by 10%, guess what? Your fund is actually not doing too badly. It's still down, but now you need to understand that in its context, the things that it can buy, it's actually doing okay. And understand then that if things have gone down last year, there is a decent chance that they're going to go up this year. And so then you've got to sit tight and do nothing. However, if the stock exchange has gone down 10% and your investment has gone down 30%, then it's probably time to do some more homework, to do some more digging, because the likelihood is that you could be in a fund that's being really badly managed, and you should be switching. Or it might be that you've bought a particular manager who's bought things that are really dirt cheap, in the hope that they're going to deliver fantastic returns. But before you do anything, before you just make a switch, the very short answer is you have to do your homework. You have to understand the context, and very often exercise another year of patience. And I want to use a great example here. Last year, we looked at the tech companies in America that absolutely boomed because of the AI boom. So we would see very large companies doubling their value over a year, which is almost unheard of. And it's no surprise that investors piled into tech companies towards the end of last year, and certainly at the start of this year. In contrast, there was this little sector called the arms manufacturers in Europe. And, middle of last year, early last year, they weren't doing very well, very much like the whole of the European Stock Exchange. But, come President Trump and his vice president, who unleashes fury at the Europeans for not spending enough on arms manufacture at the start of this year, and kind of scares them by saying we might not support you. And all of a sudden, tech shares are down a lot, and arms manufacturers in Europe are booming. You don't know that that's going to happen if you're an investor. So you need to make sure that you own, and that's maybe my second point, you own a good spread of investments, and then you stay patient.
I was about to say, I can hear you saying it already, Warren. It's about diversification. And when you diversify, I suppose you have to accept a little bit of pain. You have to know that not everything is going to do so well.
Exactly. I almost want to say to you, if you own a properly diversified portfolio of investments, there has to be one portion of your portfolio which is losing money. If not, let's say everything's delivering the same growth. Let's say your top performing investment is delivering 25% and everything else is delivering 20%. I'm going to suggest that you've got absolutely no diversification whatsoever. You might own 5 different unit trusts from 5 different unit trust managers, and therefore you feel that you're nicely diversified. But I bet if everything's performing in the same direction and in the same amount at the same time, all you've got is different brands on the same basket of shares, and that they all own together. The way that you know you've got diversification is if a few of your investments are doing 10 or 15 or 25%, and one or two of them are doing -1 or -5, because that means that they own things that are performing at a different time and in a different way. And when the cycle turns, and none of us know when that's going to happen, the things that are doing well last year might not do so well this year, and the things that were losing you money last year might become your star performers. So diversification means owning things that hopefully most of them are doing well and some that aren't doing well, and that's a badge of honor. You need to know this is a good thing. That clown on the radio who tells you about diversification is actually telling you some of your stuff is not actually going to do well every single year of your investment career.
Is there a sort of percentage of doing badly that you should tolerate, and past that zone, actually, you need to change things? If 10% of your investments are losing you money, do you need to sort of, is there some sort of rate at which you kind of think you can look at your spread of diversified investments and think, actually, I'm losing too much here? Or does it also depend, I suppose, on how well the rest of it does?
I think that's a good comment. If you've got a portion that's doing incredibly well and a larger portion that's not losing very much, but it's not doing well, if on balance you're still growing your money, that's a very good sign. I think at the start of the segment you said consistency. So, I mean, in an ideal world, what you're aiming for is, an investment portfolio that grows, year after year, and it may not reach the peaks of the stock market. So if the stock market's generating 25% and your portfolio is only up, 10 or 12%, but the next year the stock market's down and your portfolio is up 8%, well, that's good diversification. So I think I would say you're aiming for consistency, and secondly, you need to understand each of those pieces of your portfolio and look at them in their context. So let's just look at global investments did really well last year, but fast forward a year and the rand is a little bit stronger than it was a year ago. So when you look at your global investments, they might not look that great, whereas the JSE is probably still up around 25% over the last 12 months. So just understanding each piece of the puzzle and then looking at the whole, you would hope that more than half, maybe 60 or 70% of your investments are growing. But I always remember a very famous investor called Sir John Templeton, and he says over his entire career, he thinks he did incredibly well because 51% of his investments made money and 49% didn't.
Sure. Yeah, no, that does make sense. Warren, we have a question for you from Michael. He says, I see some investment companies have now launched exchange-traded funds that seem to be the same as their unit trusts. What's the difference? Should I buy the ETF or the unit trust? Michael, we'll have an answer for you in just a moment.
The Money Show.
Personal Finance with Warren Ingram.
And Warren, there was a question for you from Michael saying that some investment companies have launched exchange-traded funds. They seem to be the same as unit trusts. What's the difference? It's a fascinating question, actually, because I think this is where the complexity or the technicalities of it can almost overwhelm us ordinary people.
And every single day there are more and more versions of exchange traded funds that are getting launched. So now when just a very quick history lesson, when exchange traded funds were first launched, all they were index tracking investments. In other words, something that would track the top 40 shares on the JSE or the American stock market or the world stock markets. It was very simple. You knew what you were buying because it was just the entire market, or as close to the entire market as you could get. And they were very low cost, very efficient, and very easy to understand. Unfortunately, the financial services industry doesn't like simplicity. So what it did is it created complexity. Every new entrant into the exchange traded fund market had to be a little bit different and had to differentiate themselves and find ways to attract assets. So now we're in a world where there are a huge range of exchange traded funds, including these relatively new things called actively managed exchange traded funds. So now you'll get an investment company that's been running unit trusts for the last few decades, and they will go and launch an actively managed exchange traded fund that looks identical to the unit trust that they've been managing for many decades. And I think it is confusing, and I understand Michael's question. Maybe for me, I think simplicity is always valuable. So in a situation like this, I think you cut it down to the way you're going to invest. So if you've got a monthly debit order and you want to keep your transaction charges as low as possible and keep things easy and simple, then just go for the unit trust that's appropriate for you. If you've got a portfolio of shares and you tend to operate a stockbroking account, and you're going to be investing, ad hoc amounts every now and then, you're going to buy or sell something, then perhaps the exchange traded fund is better because it's not going to be that efficient for monthly debit orders. But you need to be careful. Exchange traded funds, they're going to cost you money when you buy them, and they're going to cost you money when you sell them. So you don't want to be paying away the bulk of your money for small trades of 200-300 rand, where you're actually paying a huge brokerage cost. So I would say, Michael, very large lump sums. If you're not in the unit trust world and you want to stay in the stockbroking world, do large lump sums on exchange traded funds. If you're going to do debit orders, then consider unit trusts. I hope that helps to kind of give you some direction.
No, I think that must do. All right, thank you. In terms of sort of staying online, in other words, staying on in your line and not chopping and changing, there's a lot of noise. I mean, when something happens in the markets, and I mean, I contribute to the noise, so I know of which I speak. But how do you avoid the noise?
I think you've got to listen with a pinch of salt. So understand that the people that are in the media, whether it's on radio, TV, nowadays, a lot on social media, the people that develop a very big following, and I always think of kind of Jim Cramer in the States, they develop a very big following because they're great entertainers. They can deliver a fantastic message with a huge amount of confidence. They sound intriguing. They throw a lot of facts at you, and that's it's entertainment. It's not investment recommendation. The people that are commentating know nothing about you, so they're giving a view, and it might be given with the best will in the world and the best intent, but that doesn't mean that it's gospel advice that you should be saying, I'm going to follow them because they sound like they know what they're talking about. I think if you want to make sound investment decisions, develop an investment strategy that focuses on 5, 10, 15-year time horizons. Don't worry too much about what happens over a day or a week or a month or a year, because an enormous amount can happen in a very short space of time, and it could drive you crazy trying to anticipate where markets are going, trying to understand what all the experts are saying about the next week or the next month. And what you need to know is economists can't even predict the direction of interest rates from one month to the next. They can't tell you with any accuracy whether interest rates are going to go up or down over a 1-year period. So if they're on the radio or they're on TV and they're blaring their views, they're entertainment. That's not the way you make investment decisions. You need to say to yourself, this is my age, these are my investment targets, this is what I would like from my money, and then make decisions for the next 5 years. And if you're always focused on that long-term view, then the short-term stuff that's happening is maybe interesting. I mean, my view is you can give it kind of a little bit of attention, but not too much, and rather sit with long-term goals and ignore the noise. And I think if you want to understand the great investment experts, they usually start with things like, I'm not really sure what's going to happen. I don't really understand what's going on right now. They're not hugely confident. They don't sit there with very confident predictions. They sit there saying, we think this is how the world's going to unfold, but we're not sure. And for me, the one lesson here is overconfidence in the investment industry is a real wealth killer. So it's okay to be uncertain, but don't chop and change. Stick to the long term. My famous D word, diversification, is your big friend in a situation like this. And if you can be diversified and have a long-term focus, I think you're largely insulated from the noise that's freaking everybody else out.
There was a piece, I think, in MoneyWeb, I think it was by Isaac Oerdendaal, who, if I remember, is at Old Mutual, who said, nobody knows what's going on. And that, to me, just explained precisely the situation we're in at the moment.
Exactly. It takes a lot for a so-called expert, when they get asked a question on the spot to say, I actually have no idea. That what they're going to do is give a view because they were asked for a view. But if they were really honest, they would say, I don't know. However, this could happen. We could be going left, or this could happen and we could be going right. And these are the range of outcomes that we should expect. But for someone like me, as just an investor, and I just want to grow my money, that view based on what's going to happen in the next week or month or even year shouldn't really change the direction of my investment portfolio. It should be built for 5 or 10 years, and it should be built to deal with all of this kind of noise that's going to happen year after year.
Well, Warren, as always, thanks very much indeed. Warren Ingram, co-founder of Galileo Capital and a certified financial planner. If there's someone in your family who you think needs to listen to this, do send them the podcast, which will be available in a few minutes.